Many accounting students lose marks in ICAM and ACCA exams because they confuse provisions, contingent liabilities, and contingent assets. But the truth is, IAS 37 is one of the easiest IFRS standards once you understand one simple rule. So in this video, I will explain IAS 37 in the simplest way possible with examples so you can remember in the exam. Now, what is IAS 37 all about? IAS 37 deals with uncertain obligations. Sometimes a company knows that it has to pay money in the future, but the exact amount or timing is uncertain. The company does not know how much it is going to pay in the future, and also it does not know when. So timing and amount are uncertain. Now, instead of ignoring these obligations, IAS 37 provides rules on how to treat them. The standard focuses on three things: provisions, contingent liabilities, and contingent assets. So if you understand the difference between these, then you have understood IAS 37. Good. Now let's take them one after the other. What is a provision? A provision is a liability with uncertain timing or amount. So you are not certain about the amount that you are going to pay, and you are also not certain about when you are going to pay it. So that is what a provision is. It is a liability with uncertain timing or amount. In simple terms, it means the company knows it will likely pay, but it is not exactly sure how much or when it will pay. However, IAS 37 says a company should only recognize a provision if three conditions are met. I want you to remember PPE, and you'll not forget it. The first P is present obligation. So when there's a present obligation from a past event, that is one of the conditions. The second P is probable. When it is probable that the company will have to pay. And then the E is for estimated reliably. So when you can estimate the amount, reliably. So when you remember PPE in the exam, you won't forget it. P for present obligation from a past event. The next P for probable, when it is probable that the company will have to pay. And the E for estimated reliably, when you can estimate the amount reliably. If these three conditions exist, the company must record a provision in the financial statements. Let me give you an example. Imagine that the company sells 10,000 televisions with a 1-year warranty. Now, from past experience, the company knows that at least 5% of the TVs will require repairs. So the company does not know when the TV will fail and require repair. And it also does not know which of the TVs will fail. But it knows that some will fail. And from experience, the company knows that it is 5%. So the company records a warranty provision. Now this ensures that the financial statement reflects the expected costs. So that's an example. Now let's move to contingent liabilities. A contingent liability is a possible obligation. It is possible. The key word here is possible. This means the company may or may not have to pay, depending on future events, because the obligation is uncertain. Now, IAS 37 says, do not recognize it in the financial statements. Instead, the company should disclose it in the notes to the account. So don't put it in the body of the financial statement, but disclose it in the notes. Let me give you an example. Imagine that a company is being sued for 100 million naira. The lawyers believe there is only a 30% chance of losing the case. Because the payment is not probable, the company does not record a liability. Instead, it simply discloses the lawsuit as a contingent liability. Now let's move to contingent assets. A contingent asset is a possible asset that depends on future events. IAS 37 takes a very conservative approach here. Companies should not recognize contingent assets. Why? because recognizing uncertain gains may overstate profit. Yes, so that is in line with the concept of prudence. Good. Now let me give you an example. Imagine a company suing another company for damages. If the company wins, it may receive 200 million naira. However, until the court decision is certain, the company cannot recognize the asset. At most, it can disclose it in the notes if the inflow is probable. That is how it is. So now let's look at the simple IAS 37 exam rule that you should never forget. Good. If payment is probable, recognize the provision. If payment is possible, disclose a contingent liability. Disclose it in the notes to the account. If payment is remote, do nothing. So for assets, if inflow is probable, you disclose only. If inflow is virtually certain, recognize the assets. So let's quickly do a recap. A provision is recognized when there is a present obligation, probable payment, and reliable estimate. So always remember PPE. Now, a contingent liability is a possible obligation that is only disclosed in the notes, not put in the body of the financial statements. A contingent asset is a possible gain that is usually not recognized because we want to be prudent. We don't want to recognize an asset that you may not get. IAS 37 exists to make sure companies do not hide liabilities or exaggerate their profits. So if this explanation helped you understand IAS 37 more clearly, give this video a like. And if you're preparing for ICAN, ACCA, or accounting exams, subscribe to Accounting and Finance Coach for more simplified IFRS explanations. So in the next video, I will show you the fastest way to solve IAS 37 exam questions.